Good afternoon, ladies and gentlemen, and welcome to the seventh Fireside Chat hosted by Credo Wealth. For those of you who may not know us that well, Credo is an independent wealth management business founded in London in 1998. And over this journey of 23 years, we've grown to a size of some £4.3 billion under administration today. And we serve approximately 7,000 clients in the United Kingdom, South Africa, and elsewhere. My name is Deon. I'm the Chief Investment Officer of the firm. And when I'm not locked down at home, I operate from our offices in Marylebone in London. It gives me great pleasure to welcome today's special guest. Cullen Roche is the founder and Chief Investment Officer of the Orcam Group. He is an expert in monetary economics and a number of related fields, and he's also a prolific writer. Not only has Cullen published his own book, he's also contributed to a number of investment classics. And he also maintains a website, which I can highly recommend to anyone interested in the field. It's a treasure trove of wisdom and insight when it comes to the world of investments. Cullen is regularly cited in the Wall Street Journal, on CNBC, and in the FT. He described himself as a financial nerd who enjoys running slowly, surfing badly, eating and drinking too much, working on cars that he doesn't quite understand, and trying to be a farmer. All of this whilst not taking himself too seriously. So, Cullen, good afternoon, or should I say good morning. You're talking to us from San Diego, right?
Yeah, good morning for me. Good afternoon to all of you guys. Thanks for having me.
Yeah, thanks a lot for joining us. How are things over there on the west coast of the USA in terms of lockdown and COVID and everything going on in the world?
Pretty good for now. We bungled quite a few things. I think initially the United States, I think it was Winston Churchill actually who said that the United States will do all the wrong things until they're forced to do the right thing. And that's pretty much how this whole thing with COVID has gone. We tried all the wrong things, and it seems like finally with the vaccine rollout and all that, we're finally getting our act together. So things are starting to improve, and it seems like we might have a normal rest of the year.
Yeah, that's great. We only started coming out of lockdown in the last couple of days in London, and I managed to sneak in a haircut just in time for this. So I'm glad at least we're there.
Me too.
Before getting into the Q&A, I'd just like to make a few introductory remarks and just talk about my own experience with Twitter over the last 8 years, because I joined the platform in about 2013. And clients and friends will know that I've often said how much this has changed my life for the better. I've learned so much about the world in general, but certainly the investment field, from experts in the various specializations. Most of it in real time and all of it for free. And none more so than all the tweets that I've learned from you, Cullen, when it comes to the role of the Fed, QE, inflation, and a number of related topics. And that's what I'm going to try and share today with the audience. So just before I ask, the first question, just to thank you for all that financial education over the years. And I'm really looking forward to this. Thank you.
Oh, yeah. It's a great community. If you're into finance, Twitter is really an invaluable resource. When you connect to the right people, it gives you access to just people and information that you could never otherwise get access to.
It's true. It's a really good ecosystem. So I think just starter for one, if I may, just tell us about your journey, your professional journey over the last, a couple of decades or so from,
Sure. Yeah, I started at kind of the bottom of the barrel. I actually came out of college. I was selling life insurance for a big firm on the East Coast. And I worked my way through basically a call center there selling like long-term care insurance and whole life insurance into Merrill Lynch, which was where I really had this dream of being sort of someone who would sling stocks and bonds for a living and be more of a trader, portfolio manager type. And so I got onto a big team with Merrill Lynch. We were managing back then, it was about $500 million, which was a lot of money for a team back then. And I was kind of the low guy on the totem pole, and I just absolutely hated it. I hated so many things about the business model. I didn't like or agree with the fee structure. I didn't agree with the products we were selling. A lot of it was just commission and fee based. And so I thought there were conflicts of interest with my clients. And only a few years in, I actually got up and left. And I left with only about probably $10 million of client assets and a handful of clients, which in retrospect was probably pretty stupid. But I kind of transitioned into managing a limited partnership, which evolved into running actually a very actively traded stock picking strategy that I ran basically through 2011, through the financial crisis. And the financial crisis was really a wake-up call for me, because I realized at that point that if you didn't understand the macro landscape, if you didn't understand the big fundamental dynamics that were going on, especially at the government policy level and the institutional level, you really were at a huge disadvantage. And I had spent a lot of the post-financial crisis period and during the financial crisis period just really trying to understand the plumbing of the financial system and accessing people in very high places who had direct access to these programs and all the things that most of us are well aware of today. And that it's completely transformed my whole career into what I'm doing now, where I'm running these very sort of simplistic to some degree top-down strategies that are macro-based, but really designed to take advantage of big macro trends in the world.
So that journey that you've just described, and through the financial crisis, 2011, and government, at the macro level, that leads perfectly into a question about the Fed, which, I always knew we were going to talk about today. A lot of people think they know what the Fed does and have an opinion about the Fed. But I found that for the most part, actually, a lot of people don't really have a clue. I know you do have a clue, and maybe just in a nutshell, if you can just sort of explain the role of the Fed, and specifically, through the financial crisis of 2011, and we can talk about the intervening years after that.
Yeah. So most people think of the Federal Reserve and central banks in general. I mean, the Fed is not that dissimilar from most central banks around the world, in that the way that they're really structured inside the modern monetary system is that they're mostly just a clearinghouse for banks. So the way that I like to think of it is that you have really a dual banking system in most developed economies these days, where you have the banking system that the rest of us use. We all bank at banks, we take out loans, and we have our deposits that are there, and the banks transfer those deposits between one another. And what we kind of discovered in the late 1800s and early 1900s was that this interbank system of transferring deposits was very fragile, and it would oftentimes collapse the entire banking system, which would actually exacerbate a real economic downturn. And so you'd get kind of a regular occurrence of basically what we saw in 2008, where you saw that the financial system started to fall apart. And because the financial system was falling apart, it would lead into things getting worse in the real economy. People that had no involvement in the financial crisis were being impacted by the fact that their bank maybe wouldn't transfer a payment for them. And so it exacerbated these problems. And the Federal Reserve, actually, one of the really interesting things about 2008 is that the Federal Reserve operated in a nearly seamlessly perfect way in terms of the way they're designed to operate, because the Fed is the bank for the banking system. So that's where the second tier of the banking system comes in. And they help to transfer those deposits. And they do that by basically creating what we call reserves and reserve balances, reserve deposits. And so the banks transfer their reserves inside of the interbank system. And the kicker with all of this is that when the system becomes fragile, the Federal Reserve you never have to worry about whether the Fed is going to transfer a payment on behalf of a bank. Whereas you actually do need to worry if JP Morgan is going to be willing to transfer a payment to Bank of America, for instance. So the Fed kind of operates as almost a backstop there, where they keep the banking system operating regardless of what's going on. And they'll shut down bad banks and whatnot, but central banks are really just big clearinghouses, and that's the most important role that they play. They're not necessarily, a lot of the stuff that we talk about today, the quantitative easing and the changing interest rates and stuff like that, it's all kind of a secondary factor to this primary role that they're playing, where they're doing this every second of every day, essentially, where they're just clearing payments. And that's the biggest, I would say, the biggest, most important role of a central bank.
So you just mentioned quantitative easing. If I may ask you, how would you evaluate, score them out of 10? The Fed operating through 2008-9, I guess the crux was in September, October 2008. And then the sort of 10 years after that until we got to the beginning of last year. So that's the sort of long second phase. And then COVID hitting a year ago and what they did in the wake of that. So those three phases, the GFC itself, the decade after that, and then most recently.
Yeah. Well, I think one of the things you recognize when you understand that the Fed is a bank for banks is that they have a fairly limited arsenal in terms of what they can actually do and how they can actually impact the private sector. And so most of their policies have to filter through the banking system, basically. And so in a lot of ways, Federal Reserve policy or monetary policy in general is a fairly blunt instrument just because they don't have the direct access that, for instance, the Treasury does. The Treasury can send checks directly to people. The Fed can't make a loan to me, for instance. So they can make a loan through a bank to a small business. They did a lot of that in the last year or so, but a lot of it is much more indirect. And so it's hard to grade them only because they've done a lot. I think they've done as much as they could, but their toolkit is just fairly limited relative to what the Treasury has done. And so that's the thing that I often try to emphasize is that the Fed on its own is not nearly as powerful as a lot of people like to emphasize. But when it's operating in tandem with its Treasury, a central bank can be incredibly powerful because then you're blending monetary policy with fiscal policy. And that's where I would argue the big bazooka really is.
I guess what's behind my question about grading them is, this concept which I've seen you talk about. I don't know if it's your term and if you're quoting someone else. I think it's yours, where you talk about the Fed derangement syndrome. You get these commentators like Jeffrey Gundlach, a year ago, basically saying that what the Fed was doing in April, May last year was illegal. And other critics like Shamat Palpatier, the venture capitalist from Canada, saying similar things. Just your sort of response to these Fed derangement syndrome, pundits, if you like.
Well, those comments are interesting because Gundlach, for instance, in that situation was just fundamentally wrong. We actually litigated all of this in U.S. courts following 2008. Nothing that the Fed was doing following the pandemic was illegal. I mean, they actually have almost an uncomfortable amount of flexibility in terms of what they could potentially do in an emergency situation because of, in the U.S., it's called the exigent circumstances clause, and it allows the Fed to, in really unusual circumstances, do virtually anything. I mean, they theoretically could start making loans to me if they wanted to, and so there's some, I think, leniency in what they're able to do, and they were arguably, towing the line there on what was legal or potentially going to be legal, but. A lot of the criticism to me is based on, I think, just misunderstanding. A lot of people misunderstand what the Fed is at heart, and they misunderstand the guts of the operation and what they do, because a lot of people, I think, have been sort of trained into thinking that money printing, as the term is commonly used, they think that that's what central banks do. And I would argue it's a lot more complex than that. In theory, a central bank can print money, but more accurately, it would be, I think that sort of a term would be used when the Treasury is operating in tandem with its central bank. And so I think a lot of people just misunderstand and are kind of poisoned by concepts like monetarism, where they just think that money is the thing that causes inflation and that the central bank is the money printing entity. And therefore, anytime the central bank is expanding its balance sheet, that must necessarily be bad money printing.
So we're going to get back to inflation certainly in a few minutes' time. But before we get to that, on this point of money printing, can you maybe just explain in your way, what exactly is quantitative easing, how it works, and how that feeds into a discussion around possible inflation or disinflation?
Yeah, so I think the thing that a lot of people misunderstand is that on its own, quantitative easing is a very simple program, and that what the central bank is doing is the central bank expands their balance sheet, and they essentially go out into the marketplace and they purchase a financial asset. So they create a reserve deposit, and they utilize basically a bank as an intermediary. The bank will actually credit someone's account with a deposit. And so, for instance, let's say they're buying the bond from me. I'm selling my treasury bond. I'm selling it to the bank, who on-sells it to the Federal Reserve, and I'm credited with a deposit. And so when you look at this policy in the private sector in solitude, all that's happened is there is just a perfectly clean asset swap. I have basically changed what was sort of a savings account in a treasury bond to a checking account. And my quantity of financial assets have not increased. My income has actually gone down. But on the whole, the private sector isn't necessarily better or worse off. So I always like to describe QE as a pure asset swap. It is just a clean exchange of financial assets. So, where the policy really can be, I think, a differentiator is if the Treasury is spending, let's say, inordinate amounts of money like they were in the last few years. Well, yes, they're implementing, the government as a whole is implementing an asset swap, but the government's also expanding their balance sheet, which means that they're actually creating net financial assets for the private sector. And that's the most important issue, is that, the way to think of this is if, for instance, the Treasury was running a surplus, meaning they were actually shrinking their balance sheet, they'd be removing financial assets from the private sector. So if the Federal Reserve at the same time was implementing quantitative easing, well, in what world would you call that money printing? Because they're just swapping some of the existing assets out for deposits. But on the whole, the private sector's balance sheet is actually shrinking. So I think you have to look at the totality of what the government is doing to fully understand whether quantitative easing is having the impact that a lot of people theorize that it does. But there's a lot of other transmission mechanisms, like the people argue there's a wealth effect and portfolio rebalancing and all these other things that I kind of think people tend to probably overemphasize. But at a fundamental accounting level, quantitative easing is not necessarily equivalent to money printing in any meaningful sense, because it is just a pure asset swap.
And just putting that through to the whole inflation question, or deflation, disinflation. I've heard you before talking about the fact that when the Fed buys that bond from the private sector, they might as well bury it in the backyard in terms of their treatment of it.
Yeah.
Maybe you can just expand on that logic.
Sure. So I think that's the important thing, is that when a lot of us make loans, for instance, if I was to make a corporate loan to someone, my corporation's balance sheet expands, and so does the consumers, or the other side of the borrowing party. Whereas when the Fed expands their balance sheet, and we're both in the private sector, so that's the important issue there, is that the Federal Reserve, when they increase their balance sheet, yes, technically they're creating new money and they're sending it out into the private sector. But when they take that bond onto their balance sheet, that bond is it's non-existent for practical purposes, because the Federal Reserve is not out there competing for goods and services. And so when I refer to it as an asset swap, you really have to keep that point into consideration, that the central bank is taking an asset out of the private sector that was actually a higher income generating asset, and they're essentially removing it. It's almost exactly like if you printed some money and I swapped it with your cash for cash, and I buried the new cash, or the cash that you gave me, in my backyard. That's essentially what the Federal Reserve is doing. The money is not in the real economy. It's not likely to have any impact on inflation whatsoever. And so the question becomes well, if you switch a checking account for a savings account, or vice versa, do you really expect people to spend more? Should we go out and, bid up the price of goods and services just because of that asset swap? And my argument has always been that, there's no reason to expect inflation to meaningfully change because of that.
And I'm right in saying that it's essentially this logic that sits behind your own conclusion over the last, since I met you in inverted commas on Twitter, which is now 8 years ago, that we weren't really in for any inflation, in spite of the sort of, inflationistas who were calling for inflation, maybe even for hyperinflation based on rounds and rounds of QE.
Yeah, I think that's been the big important point, has been that quantitative easing in solitude just isn't nearly as powerful as a lot of people assume. And that my big argument coming out of the financial crisis in particular was that the fiscal entities weren't doing enough, that treasuries around the world were not spending enough money to actually create the type of inflation that people expected from the central banks. And so coming out of 2008, I was very much not a deflationist, I was a disinflationist, which basically meant that I expected a falling rate of positive inflation, which was essentially what we ended up seeing over the course of the 10 to 12 year period following the financial crisis. The psychology regarding all this has kind of changed in the last year, because the treasuries around the world have been much more active. I mean, the United States has spent huge amounts of money to fight this thing. And so I've argued that essentially my big macro view was that the big macro, the secular headwinds that we're facing in terms of demographic trends and technological trends, and these big macro factors that are pushing disinflationary trends upon all of us, that those trends were so powerful that you'd have to implement just colossally huge fiscal policies to even put a dent in those things. And that's to some degree what's going on now. And we're beginning to see that impact to some degree. So I guess I would describe myself as a bit more of an inflationist coming out of COVID, certainly compared to 2008, just because the fiscal policies are so much bigger. But I do not foresee a very, very high inflation or a double-digit inflation or anything like that. Certainly not in the developed world. I think you would need a sustained type of fiscal response like we've seen in the last year to start to trigger something like that. And the likelihood of that happening, I think, is not very high.
So if you had to sort of fast forward, I mean, I know nobody wants to forecast to a specific timeline, but if you go forward a couple of years, let's say, maybe 3 to 5 years max, where do you see inflation heading? To the 3-4% level, or to the double digits, or what sort of ballpark do you have in mind?
Yeah, so I've basically, my underlying inflation models are basically looking at something like 3% later this year. And a lot of this depends on policy. So if the policies were to, let's say we had another hiccup with COVID and the fiscal entities were to come out with, another big round of spending packages, I think you could get a bump up into 3.5% inflation or so in 2022. And I've been kind of saying since the very beginning of COVID that I think that the Fed at some point will have to backpedal very quickly here. I think that there's a chance that we could get into the back end of this year and the Federal Reserve could be telling a very different story about interest rate hikes than they are right now. I think right now they're jawboning to try to make sure that the recovery is fully gaining traction, that things are really on solid footing. And I think in the back of their minds, I think they're getting a little worried about inflation and preparing to increase rates. Probably not this year, but I would not be shocked by rate hikes in 2022.
I was going to ask you about that, because it was September last year that Jay Powell said at the FOMC that they will keep rates at the level that it is and has been until two conditions are met. One is that the US gets to maximum employment, which I think is unemployment of about 4% is the technical level.
Yeah.
And that inflation exceeds 2%, and I quote, for some time. So the question is, what does for some time mean? Does it a few months? Does it mean a year or two? And when does it backpedal? Because just before you answer, if you look at just what the yield curve has done in the last few months, with new data points coming out, the long end has moved up 30, 40 basis points. But the short end hasn't moved. It still seems to be believing the Fed. So the question is, when does it move?
Yeah, I don't think the short end won't start to move until the Fed really starts to change their language. Because the way that I like to think about interest rates is that it's a bit like walking a dog, in that if you have a leash in your hand, and you think of the interest rate structure as being, the basically the length of the leash. The dog is, for instance, on the 30-year Treasury, and the Fed kind of lets in theory, they could pull the leash in. They could eliminate all the outstanding maturities, and they could control the 30-year by setting the price. In theory, they don't do that though. They let the 30-year float basically. So the interest rate structure is a lot like a leash, in that the dog just is allowed to sort of wander and sniff and poop wherever it wants to and go do whatever it wants all along the way. But at the short end, where the leash is actually in your hand, you have absolute control. And the yield curve looks very much the same in terms of the way that the Fed has control over it. And so the short end is basically, it's absolutely controlled by the Federal Reserve, and it will not move until we start to see the Fed really start to communicate that they're going to change their policy direction, which I'd be shocked if they really started to say something different before early next year, because I think they want to make sure that they have completely gotten out of the woods regarding the COVID recession and whatnot.
Can we take the conversation back to the Treasury spending, please, and feed into sort of two topics that I think are related. One is just the issue of national debt, and if we want to sort of cast the net wider, global debt, because you often see some of these bearish commentators saying, global debt has reached, I don't know what, some impressive number of a few hundred trillion. And whenever I see those headlines, I ask myself, who do we owe it to Mars or somebody? The US debt clock, I think, shows a number of 28 trillion today, which is a debt per citizen of $85,000, I think, in round numbers, per citizen. I mean, do you see that as a problem, or how would you sort of explain it?
Well, the national debt is tricky. I mean, I think that the thing that a lot of people look at the government like it's a household, that the government has to repay its debts. And I think one thing that's really useful about understanding the world from a macro perspective is that you begin to understand that, for instance, no sector repays their debts. I mean, if you look at aggregate corporate debts, for instance, or aggregate household debts, or aggregate government debts, these charts, I mean, they go like this in perpetuity. And they should, because when you think about balance sheets from that perspective, it's just assets and liabilities. So the government's liabilities are our assets. All the corporate liabilities that are outstanding are somebody else's assets. My liabilities are some other household's assets. And so there's nothing inherently evil or good about debt in and of itself. They're just assets and liabilities. They represent the transformation of balance sheets over time, and what we owe over a certain time period. But I think one of the important things is that you really want these balance sheets to be expanding over time. You want people to be taking out loans and expanding their balance sheets to, build homes and build businesses and do the things that really improve the economy in the long run. I think that the whole concept of repaying the national debt, or this household concept, is, I think, sort of misconstrued. And the important point regarding all of this is that you have to understand, what is going to be the inflationary impact. It's not about solvency per se, because the government is an aggregate sector that doesn't go bankrupt on itself. It doesn't take itself to bankruptcy court. So it really doesn't have a solvency constraint in the same way that I do, because somebody else can take me to bankruptcy court if they think I have, liabilities that I can't pay. So for the government as a whole, it's really more about what is the inflationary impact of their balance sheet expansions. And to some degree, we're sort of in a really interesting testing environment here with all the unusual circumstances with COVID, because we're finding out to some degree what is going to be the limit of these government balance sheet expansions. And so, taking it back to that sort of 30,000 foot view, I think that the quantities of government debt creation to this point do not represent a hyperinflationary or some sort of, systemic risk that could, collapse the whole financial system. But I do think it's going to cause some inflation in the coming years. And I think that it'll be interesting to see how much inflation we get out of this, just because I think to some degree, we're testing the limits of what the government can do on the fiscal side.
But just extending this discussion slightly further, and I don't want to get into sort of Democrat versus Republican politics here, but I think it also links to the question of the modern monetary theory, doesn't it? That the balance sheet expansion, you might as well keep on doing it. If a government that can print its own money might as well keep on doing it. Maybe they don't even need tax revenue. How do you respond to that kind of logic?
Yeah, well, the MMT people, I think they tend to take a lot of these things, a lot of these narratives to extremes. And I think some of their fundamental operational explanations are wrong. I mean, they like to say things that like taxes don't fund spending. And I would argue that a credit-based system is totally based on anyone's income. What the real resources you produce are a function in part of your income and your credit, and anyone's ability to expand their balance sheet is limited by ultimately what their incomes are, because income creates basically a financial flow that doesn't require you to expand your balance sheet. And so if you don't have income, in theory, you can borrow and borrow and borrow, but at some point it creates for a government, a real solvency problem, an inflation problem. So, there's certain narratives in MMT that I find problematic from an operational perspective. I think one thing that I do agree with MMT is that they're changing a lot of the narrative from the focus on monetary policy to fiscal policy. And that to me is actually sort of a welcome sea change, in that economics over the course of the last 30 years has focused so much on monetary policy and what central banks can do. And I think in the last 10 years, a lot of people have started to realize that central banks really do have fairly limited toolkits, and that you need a fiscal response to some degree to make the central bank's policies really effective. And so MMT's narratives, I think, have contributed somewhat positively in that sense. The worrisome thing with MMT is I don't think they understand inflation. I don't think they know what the limit of all of this really is. And I think there's maybe not for big developed countries with these big secular deflationary trends, but I'd be very worried, for instance, if I was a South American country or an emerging market, that if one of these countries were to develop a fully sort of MMT style approach to policy, I'd be very worried about the long-term ramifications of what that would do, because I don't think they have a real policy grasp on how to actually control the inflation when it arrives.
Am I right in saying that last point is based on essentially the size and the productivity of the real economy behind it?
Yeah, I mean, I would argue that virtually anyone's credit is based ultimately on their real resources. I mean, my credit is based on, how productive am I? What are the real resources I have? How, my ability to expand my balance sheet ultimately is based on all of those things. The government is just a great big aggregated version of that. And so it's important, to understand the real resource constraint. The tricky thing is, in terms of understanding what the real solvency constraint is for the government, it's just, I don't know if anyone fully understands what really causes a country to move from a moderate rate of inflation into a very high inflation. There are certain circumstances that are consistent across historical hyperinflations, for instance, like war and political regime changes and things like that tend to be precursors to a what would typically be a response of money printing that ultimately leads to a hyperinflation. But ultimately, I don't know if anyone fully understands what causes inflation, for instance, to move from 5 to 10 to 15 to 50% in those phases of an inflation that can be really catastrophic along the way to a hyperinflation.
So what do you say to Mr. Michael Burry, who made some money in The Big Short, the famous hedge fund manager, who came out, was it last week or the week before, and he said that we're facing hyperinflation in the States and in the world?
It Burry's a lot like Gundlach. These are guys that I have huge amounts of respect for, but they're not macroeconomists. These are guys that they specialize in really, fundamental, bottoms up type of analysis. They're very good at, Gundlach is a bond genius by any measure. He's a master of understanding individual bonds. Burry is a master of individual stocks. He understands these individual entities 10 times better than I ever could. But when it comes to these big macro, discussions, I think these guys get a little bit out of their lane. And I think that, Burry, I think, was predicting hyperinflation in the United States. And I who knows? I mean, I could end up eating crow on all this, but I don't see it. I don't see the macro environment for a hyperinflation in the developed world because I don't see that these big secular headwinds that we've been facing are going to be overcome by, 30 years of demographic trends and technological trends aren't going to be completely blown up by 1 year of big spending programs. That's just not typically how a high inflation works. If you were to get a sustained, 5, 6, 7, 8 years of these huge programs and people, staying out of the workforce and, being unproductive and supply chain problems and things like that, I think it would be a totally different story. But I just don't see that being in the cards for the global economy and especially the developed world in the years to come.
So just sort of rounding off on this whole conversation about inflation and inflation feeding into what's bound to be higher interest rates in the world in the next few years. I just want to talk about, the bubble narrative. I want to talk about asset prices. And I specifically want to ask you about your column that you wrote about a month ago under the title, Why Stocks and Bonds Are the Core of Any Portfolio. So my question to you is, why are stocks and bonds still the core of any portfolio in spite of both these asset classes trading at all-time highs as we speak and bound to be under some valuation kind of pressure from interest rates going up?
Yeah, I think that's a good way to think of this stuff is that, to some degree, all of these assets are unusually risky compared to, their historical averages in terms of valuations, in terms of interest rate risk and things like that. I think that when I think of, so I work with a lot of retail investors and I work from a planning, even though I'm primarily a portfolio manager, I work from a planning-based foundation. And a lot of that involves running balance sheet and income statement analysis for people and establishing, withdrawal rates and what is a typical type of return that someone might need in retirement, for instance. And so I think when you come to, that sort of an analysis of how you're going to allocate your assets, stocks and bonds serve as the core asset class because they're the income generating, cash flow generating instruments that you almost have to rely on to some degree to create some predictability in the next 5, 10, 15 years. I mean, for instance, you can't look at Bitcoin and try to predict what it's going to do on a cash flow basis. Whereas I can at least, as crappy as a 10-year bond looks in this environment, I can look at a 10-year bond and I can tell you in nominal terms exactly how much income you're going to get if you buy it today for the next 10 years. And so you can do an asset liability matching analysis based on that gives you a pretty high degree of comfort over specific time periods that allow you to plan for the future. And that's why stocks and bonds are such fundamental instruments inside of any balance sheet analysis, because they're the only instruments that we have the historical track record of and the cash flow history of to be able to actually make at least somewhat accurate predictions over the course of the next 5, 10, 15 years. And, for stocks, I can hear people in the background saying, well, stocks are not like bonds. And I actually like to think of stocks a lot like bonds, in that I think of for instance, the S&P 500, I basically think of it as a 7% yielding, very high quality bond that has about a 30 or 40 year duration, meaning that if you were to hold that thing for 30 or 40 years, you would, with a very high probability, earn something like a 5, 6, 7% coupon from that thing per year. And this is supported by history. It's supported by corporate profits. And so when you run your balance sheet analysis, you can look at that sort of an instrument, and assuming that fits into sort of a 30-year bucket in your portfolio, you can begin to run a cash flow analysis that matches your liabilities with your assets. And you can't do this most people don't earn income from their homes. They don't earn income from collectibles or gold or all of these other assets. And so the way I like to think of this stuff is that the stocks and bonds, the cash flow generating instruments, are sort of your core. All of that other stuff, it's great to invest in, venture capital with no income, or real estate that doesn't earn you a consistent income, or gold or collectibles or Bitcoin or whatever it is. But those are more tangential assets. They're satellite assets around what I generally believe should be a core component for people that generates a somewhat predictable cash flow stream in the future.
I'd like to ask you about one or two of those points you just mentioned, if you don't mind. And
Sure.
While you address it, I'd like you to, amongst other things, to sort of talk about the so-called moneyness, which I know is a term that once again you use. What do you think of not only the moneyness, but also well, if you can explain moneyness, please, the way that you see it, the moneyness as well as the prospects for both Bitcoin and gold separately going forward?
Yeah, so moneyness refers to basically what is the properties of specific types of money, and how applicable are certain instruments as money in certain environments. And so a lot of this is dynamic, but for the most part, bank deposits are the instrument with the highest degree of moneyness, because you can, thinking of money purely from, or primarily from, a medium of exchange perspective, deposits are the thing that you can basically take almost anywhere and buy almost anything. They're so widely accepted that they're considered money by the vast majority of people in terms of their exchangeability. And so they have the highest degree of moneyness because of that. For instance, going back to central bank reserve, I can't even access central bank reserves. So central bank reserves actually have a fairly low level of moneyness in terms of who will accept them and their moneyness in general. Treasury bonds are the same. They're, in some circumstances, people might accept them for payment of goods and services, but for the most part, you can't walk into a big, you can't walk into Home Depot or Walmart or some big grocery store and go purchase anything with a treasury bond. And gold and Bitcoin, for the most part, fit into that same bucket right now, where their moneyness is not very high. It seems to be changing somewhat for Bitcoin, but it's still not widely accepted. It's certainly not to the degree that bank deposits are. So moneyness, it refers to the fact that the modern monetary system is really designed around our banking system and the deposits that banks specifically create.
And what is your opinion of something like Bitcoin going forward? Are you of the school that says it's a bubble and it's going to crash, or do you think it could become a multiple where it is today at $62,000?
My view of cryptocurrencies in general is that they're a good development. I think decentralized blockchain-based platforms are good. I guess Bitcoin is the first mover in this ecosystem, so it has a natural advantage there. I guess my worry with specific coins in this ecosystem has always been, well, what stops a better coin from coming down the pipeline in the future? So, and that's the thing I think has always made me definitely not bearish on cryptocurrencies, but I think somewhat skeptical, just because I I view them almost like individual stocks. I'm not an individual stock picker. I don't believe in going out and picking individual stocks. I believe for the most part, people should just pick broad indexes and, buy and hold them and just take what the market return generates. And I kind of view cryptocurrencies in the same sense, in that I think that trying to pick the best cryptocurrencies is a crapshoot in the long run. I don't doubt that Bitcoin will exist in 50 years. I just don't know if it'll have nearly the value that it does. So, if you wanted to take sort of a really boring, efficient market type of perspective, well, the crypto world right now is about 2%, 1% to 2% of all outstanding financial assets in the whole world. If you wanted an allocation, you could go out and buy, 1% to 2% of a basket of cryptocurrencies and just buy and hold it. And that would at least give you sort of a market cap weighted asset allocation to those assets. But I'm not a huge fan of picking individual, very volatile assets like that. But again, to me, Bitcoin is sort of like venture capital in a payment system. And that's not my thing. I'm just not a believer in, or at least I'm not an expert in venture capital and picking the next big entities, the next big instruments that are going to be the ones that generate the high gains and whatnot. So I think people can benefit from utilizing cryptocurrencies and owning, a piece of it for their portfolio. But I also think people have to be really careful picking these individual entities, because we know that these things can fall 50, 60, 70, 80, 90%. A lot of them fall 100%. So I think you still have to be really careful about the way you approach all this stuff.
So a minute or two ago, you mentioned that crypto at the moment is something like 1% to 2% of financial assets. That leads me to a question about the concept, which I think you've also described as the global financial asset portfolio, ultimately, which feeds into the argument where I think you've said before that there's really no such thing as passive investing. Can you maybe just elaborate on that, please?
Yeah. So my view on, it was funny. In 2008, I was reading a hedge fund ETF prospectus, and I'm reading through this thing, and the hedge fund prospectus referred to the ETF as a passive instrument. And I remember reading that and thinking to myself, this language is nonsense. It doesn't, in no world would you consider a hedge fund, and this was a very dynamic multi-strategy hedge fund strategy that they were trying to take public. And I just remember thinking, that there's got to be a misuse of this term here that's going on. And what I sort of realized is that to a large degree, the term passive investing is largely a marketing term, in the sense that I think that a lot of firms created this term to try to create a black and white differentiator between what is basically high fee active management and low fee active management. And that's, I think, the spectrum on which it makes more sense to view active versus passive. It's not that passive is truly a thing. It's that really we're all active. We all ultimately, if you think about it from a macro perspective, again, there's one portfolio in the entire world of all the outstanding financial assets. And none of us actually own that portfolio, because honestly, it's just way too complex to actually hold that portfolio. So we end up deviating from it by definition, and that's fine. There's nothing wrong with deviating from that portfolio. But when you deviate from that portfolio, you are essentially making an active decision. And so the global financial asset portfolio tries to reflect what the overall outstanding quantity of market cap weighted financial assets is at present. And I think in terms of the active versus passive debate, it proves that everyone is ultimately active. And there's very smart ways to be active, and there's very stupid ways to be active. And for instance, I would argue that day trading is one of the stupid ways to be active, whereas buying low fee, tax efficient index funds is a much more effective, intelligent way of being active. But at its purest level, there is nothing that is purely passive.
Can I just ask you, before we start closing off, with one or two more sort of personal questions? About your book, it's called Pragmatic Capitalism. Your website's called pragcap.com as well, short for Pragmatic Capitalism. Just briefly, why the pragmatic part? And then secondly, I think it's fair to say that most of the audience today are capitalists. We're a wealth management business after all. So I'd like to hear your view of capitalism, the future of capitalism. Is capitalism in trouble because of all these inequality debates and what, what it leads to?
Yeah, I mean, in trouble, I think it's certainly, there's something in the United States, there's something like 30% of all millennials view themselves as socialists now. It's the numbers are creeping higher, almost worrisome to some degree. But I think that one of the things that I think has been a really dominant narrative in the last 30, 40 years is that I think a lot of people have sort of assumed that free markets and capitalism can solve everything, and that we just needed to let the system of capitalism sort of move to an extreme. And I think that causes its own problems in that it creates this system of inequality. I mean, capitalism is ultimately it's a monopolizing system. It will, if you let it run to its extreme, the biggest capitalists will buy all of the profitable companies that they can afford, and they will monopolize everything in extreme. And that sort of a system, obviously, it would lead to this monopolistic sort of inequality-based system that it would leave a lot of people feeling left out. And we're veering increasingly towards that type of a system where it's starting to feel like a lot of people have been left behind. And I think that the interesting sort of catch-22 with that is that, and this was something that actually Marx recognized and Keynes recognized, a long, long time ago, was that if you were to let this system run to its full extreme, that actually what could potentially end up happening at some point is that the people would overthrow that system, and that you actually create a political risk in that system where socialism becomes a growing type of popular type of system that eventually invades the economic system to a degree where you now veer in the opposite direction. And now we veer from the extreme of extreme capitalism to we veer potentially towards the extreme socialism. And that's, as bad as capitalism could be in some ways, it's the worst system except for all the rest in terms of economic systems. And so socialism in its extreme is a far worse system, something that I think a lot of young people, especially in the developed world now, do not even understand how bad these types of socialist regimes can be. And so there's a balance there. And I think that we've probably veered a little bit too far in the extreme capitalism, bucket. And I think some pullback would probably be nice, just to, walk some people off of the socialism ledge that we're, that socialism trend that we're kind of starting to see. But that's where the pragmatic part comes in, is that a lot of what I write about is writing about how the government isn't necessarily bad. In a lot of ways, the government is a useful entity that, obviously it can be taken advantage of and mismanaged and cause, catastrophic problems across the economy, but that actually the government can be utilized to do a lot of pragmatic good things. And so I'm full bore capitalist, but I understand that there is a bit of a symbiotic relationship there, that the government actually should be involved in a lot of things. It benefits us to have regulations to some degree, and it benefits us to have government investment and things like this. And I think when you approach it from a pragmatic perspective, I think you can create a little bit more balance in some of the narratives that we're having, where everything isn't these black and white things that a lot of people in the economic system like to refer to, and that a little more balance might lead to a more balanced outcomes that actually benefit all of us a little bit better in the long run.
So you refer to your writings there. Maybe you could just guide the audience to where they can find your work on the various websites and the sort of education page, I think, where you've got, must be 100 links to interesting articles and books.
Yeah, I've written, I don't know, an embarrassing number of articles over the years, 10,000 or something. So Pragmatic Capitalism is the website. It's pragcap.com, pragcap.com. There's a lot of drop downs. The educational tab will take you to actually my corporate website that has a big educational page with, it's not just my writing, it's a lot of other people's stuff. Some of the most interesting things that I've read over the years, from portfolio management to understanding the basics of money, the basics of accounting, basics of banking, things like that. You could probably spend a year going through all of this stuff and understanding it. But to me, that's what so much of this is about. It's about, making smarter decisions about the financial world by understanding the world for what it is, and really taking that first principles perspective of trying to understand how the world works at an operational level, and then applying some common sense understandings to it based on those understandings. So those are probably the best places to start for education. There's also a forum. I'm pretty active on my own website. So, I love to field questions. I love to help people understand this stuff where I can. So if people want to, interact on the forum or even shoot me an email, my contact info is on the website there. So, I'm usually pretty responsive to email, but I'd love to help people understand this stuff and try to navigate the world of finance and money, because it's just so darn confusing.
So if I look at all that stuff, that not only that you must have read in order to be able to write these things, but the 10,000 pieces you've written, you refer to that number. You run a business, you manage clients, you're a family man, you've got a daughter who must be about 1 year old when I look at her pictures eating on your Twitter feed. You compete in Ironmans, you're a farmer, you just built yourself a house. Where do you get time to read? You say yes to arbitrary people like me who invite you to a webcast. Where do you find the time?
Well, probably the biggest help is waiting till you're 40 years old to have children. I had so much free time on my hands between the age of 20 to 40 that I think a lot of people don't, just because they choose, in a lot of cases, wisely to have kids at a younger age. But no, I have a 1-year-old now, and so my time is a lot more limited. But yeah, a lot of it is, I think, again, kind of going back to the first principles of all this stuff, I've tried to navigate the world from a very, operational perspective. And I've created a framework, I think, for navigating the world that has made me at least relatively productive across the way I'm able to navigate that. And it's sort of an engineering mindset, and being very organized and disciplined about the way you're navigating things, so that you're able to be, not just effective, but very productive across that. So that and not having kids are the two keys to high productivity.
No, thanks a lot for that. So the final question I've got for you, Cullen, is your book was published, I think, in 2014. And in that book, you quote your dog, Kelly, who always reminds you that today is the best day to be alive. So firstly, is Kelly still alive?
She sure is. She's 10 years old now. So
okay. So I want to close off and quote Kelly by saying, today has certainly been a very good day for me. I've enjoyed it as I knew I would. I'm hoping that the audience felt the same way, and really appreciate your time and your insights. Thank you very much.
Thank you very much for having me. I hope everyone is being safe, and I'm glad that things are going so great in the UK, and I hope it continues.
Thank you. The same on that side, and I hope to buy a coffee one day in San Diego.
Absolutely. Yeah. Next time I'm in London. We almost met up a few years ago. And
that's right.
I'm still bummed that we didn't make that work, but
indeed,
I'll be back. I'll be back hopefully sooner than later.
That's great. All the best. All that remains for me is to thank the audience as well. Thank you for your time. And until next time, goodbye.